So, you want to invest like Warren Buffett? Well, the surprising thing is, you don't have to pull off any financial acrobatics. The Oracle of Omaha keeps it pretty straightforward. Here's the deal. Buffett puts his money into awesome businesses that are selling for less than they're really worth. And then he hangs on to those investments for the long haul, as long as they keep being outstanding. But wait, there's more to the story. In this video, we're going to dive a bit deeper into Buffett's way of investing. We'll toss in some real-life examples to show you how he rolls with his investment philosophy. Before we get started, drop a like and subscribe to our channel for more personal finance and investing content. And if you're new, leave a comment and say hi. We'll spill the beans on the stocks he's all about and the ones he wouldn't touch with a 10-foot pole. Ready to get the lowdown on the Buffett investment strategy? Let's go. Alright, so here's the thing. A sizable chunk of Buffett's investment strategy is a secret. He's super hush-hush about it. But you know, we can still see the trades that he's making, and we can also see how long he holds on to those investments. So even though his process is proprietary, there's a lot to learn from the way the guy does his trades. So let's dive right into a step-by-step guide to how Warren Buffett invests. First, you look for a margin of safety. Alright, let's break down one of Buffett's golden rules. The margin of safety. It's like the superhero cape for investors, swooping in to save the day. Think of it this way. You buy a stock for $10 a share, but the real deal is that the company's assets are actually worth $12 a share. That's your $2 safety cushion right there. It's like having a buddy who's got your back, making sure your investment doesn't take a nosedive. Now, Buffett's game plan is to always grab a deal where he pays less than what the company is truly worth. He's not into overpaying. In his words, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. So, it's all about playing it smart and keeping that safety net intact. Next up, focus on quality. This one is quite simple. Warren Buffett doesn't invest in junk. Yes, he's into buying businesses that seem like deals. However, you will not see him buying struggling businesses. It doesn't matter how cheap these businesses are. You won't see him buying any of them. Here's what he says about this. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. After that, you need to know not to follow the crowd. Alright, listen up, especially if you're diving into the investing game and navigating those Reddit message boards. Buffett's got some wisdom to drop. Don't be the guy buying a stock just because it's hot right now and everyone's going after it. For example, WeWork when it was first IPO'd. But here's the plot twist. Don't go all rebellious and sell what everyone else is buying either. Buffett's playbook is all about tuning out the noise, turning a blind eye to the crowd, and going on a solo mission to find value. And here's the real gem. According to the Oracle himself, being a smart investor isn't just about having a brain that's a walking encyclopedia. Nope, it's all about your temperament, how you handle the roller coaster of stocks. Here's what he says about the entire thing. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. Next up, don't fear crashes. Look, the obvious goal of investing in stocks is to buy low and sell high. It's common sense. However, human nature can make us do the exact opposite. 'Cause, you see, when all your friends are out there making a ton of money, you feel like you want to make money too, so you buy in on the hype. However, you've bought the stock once the hype has already increased its value. You end up overpaying, which Warren literally can't stress enough, is not a good thing. And then, when the stock market crashes, it's human nature to sell off their stock before it drops any further because, well, we hate losses, don't we? However, this is not the time to sell. It's time to hold. In fact, it's time to buy. Buffett himself absolutely loves it when the stock prices drop. Why? Because it creates opportunities to buy stocks at a discounted price. This explains why 2022 and 2023 has been particularly active for the Oracle of Omaha. Picture this. You're out there shopping at your favorite store, and you find out that the entire store's prices have decreased by 20%. Now, would you panic, go home, and start selling off the goods you've already bought from the store? Or would you grab as many things as you can afford because you know the deal is nice? Here's what Buffett says about this. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Speaking of crashes, the entire point is to think of your investments with a long-term mindset. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And that's not coming from me, it's from the wise words of Warren Buffett. The Oracle doesn't buy stocks because he believes that the price is going to rise soon. He buys them because he believes that these businesses are good, and he wants a chunk of the business for the long term. Don't get me wrong, he still sells stocks frequently, and he does so for a variety of reasons. However, he approaches his stocks with the mindset of owning them forever. And if it's difficult for you to have that forever mentality with your stocks, then Buffett says that one of the best investments most people can make is the S&P 500. Basically, invest your money in the fund and then forget about it. That's the best thing you can do. However, don't be afraid to sell if the scenario changes. However, a few years before the 2007-9 financial crisis, he observed the lender's management taking undue risks with the company's capital. Consequently, he made the decision to sell. When the financial crisis unfolded, it turned out Buffett's move was wise. So if you feel something is fishy, divest from the company as quickly as you can. Now, if you truly want to learn how to invest like Warren Buffett, you need to learn the basics of value investing. Warren Buffett is renowned as the master of value investing, a strategy that zeroes in on snagging investments at prices lower than their intrinsic values. Essentially, the goal of a value investor like Buffett is to secure a company's stock for less than its actual worth, ideally significantly less. Value investors actively seek out companies whose intrinsic values surpass the implied enterprise values based on current stock prices. The idea is that, over time, the market will catch on to the true value of these underappreciated companies, leading to an uptick in their stock prices and a profitable outcome for the value investor. In simple words, folks, the point of all of this is to buy $100 worth of a company's stock for less than $100. The next thing you need to understand is how compounding works. Warren Buffett is like the guru of letting money grow over time. He's all about using things like compound interest, reinvesting dividends, and constantly putting the cash flow from Berkshire's businesses back into the mix. How effective is this strategy? Well, since Buffett took the reins in 1964, Berkshire has scored an average yearly return of 20.1%, while the S&P 500 managed 10.5%. Now, those numbers might not sound mind-blowing at first, but here's the kicker. Over time, Berkshire's shareholders enjoyed a total gain of 3,641,613%, while the S&P 500 clocked in at 30,209%. That's the magic of letting your money do its thing for the long haul. The last thing you need to learn is how to research and reflect. Buffett has this routine where he hangs out in his office in Omaha, Nebraska for long hours, and most of that time, he's just sitting there, reading or doing absolutely nothing. He once said, "I make sure to spend a good chunk of time, almost every day, just sitting and thinking." Here's the deal. Buffett sees knowledge like it's a treasure that piles up over time. He thinks a big chunk of his success comes from gathering as many investment smarts as possible. So, while it might sound a bit chill, there's some serious wisdom brewing in those quiet moments. Now that we've talked about a step-by-step guide on how to invest like Warren Buffett, let's talk about what kind of stocks he actually buys. Alright, let's break down the stocks that Warren Buffett is into. Berkshire Hathaway, his company, has a massive stock portfolio worth billions. Even though they have around 50 different stocks, the big chunk of the money, like 3/4 of it, is in just 5 stocks. Check these out. Number 1. Apple. Buffett's got a big slice of Apple, more than 5% of it, worth over $136 billion. He's all about Apple's loyal customers, their strong pricing game, and top-notch leadership. Number 2. Bank of America. Berkshire holds about 13% of Bank of America's stock. Buffett's a fan of the CEO and the whole management team. Plus, the stock looks good in terms of value and pays solid dividends. Number 3. Chevron. Buffett got into Chevron big time in 2022, owning about 8.4% of it, valued at around $29 billion. With Berkshire already playing in the energy field, Chevron fits right into Buffett's game plan. Number 4. Coca-Cola. Berkshire owns a hefty 9.2% of Coca-Cola, which is around $24 billion. Buffett's been on the Coca-Cola train since the late 80s. He's a big fan of their brand power and wide-reaching distribution network. Number 5. American Express. Berkshire's got a solid 20.2% of American Express, totaling around $22 billion. Buffett's been holding on to this one for 3 decades. He digs the brand and the fact that American Express wears 2 hats as a payment network and lender. So, in a nutshell, these are the heavy hitters in Buffett's stock game. And when it comes to stocks he doesn't invest in, he keeps it simple. He stays away from things he doesn't get. So, you won't catch him diving into the world of super high-tech or biotech stocks, because, well, that's not his strong suit. It's not that these businesses are bad or too expensive. It's just not where Buffett feels comfortable. Well, folks, that's all for today. Thanks for watching this video on how to invest like Warren Buffett, a step-by-step guide. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more personal finance and investing-related content. In the comments below, let me know if you have any questions. Here's to becoming rich and financially free.